Hey, what's up everyone? Welcome to Tuck Notes, Beginner Stock Talk. My name's Tucker, and in this video, coming up, we're going to be talking about Tesla, the overall stock market, some different analyst views on Tesla's journey so far, and some price points we'll cover, and some economic news regarding China and the US economy. So with that, Tesla right now, some of this news is part and due from yesterday, and some of it is today. So Tesla right now is at 662. When I made this video, it was at 628. And we have been seeing an aggressive sell-off in Tesla, but I'm going to jump around in my notes. Kathy Woods bought a bunch of shares of Tesla yesterday, and we're seeing the reaction of it now, today, potentially. However, that doesn't mean there's still downward pressure. Tesla's been dropping. Tesla's dropping, and it's getting revisions from different analysts. And one analyst was at $1,500 a share, and he dropped it down to $800 a share. This is also calculations. If you know some math, this can help you to your advantage. The reason you dropped it down is because of the lockdown and the pause in production, and how it can have an impact in the pause in the production. So yesterday, I know it sounds kind of confusing. You're not alone. Yesterday, Tesla, there's an article saying, they're planning on ramping up their production to pre-lockdown output in Shanghai by Tuesday, which was yesterday. And their plans are, one of their implementations is going to be a two-shift work deal. I'll explain this as best I can. So the employee works, and I don't know how many hours they work, and then they are quarantined. That's the word. They're quarantined for 24 hours, and then they work a second shift. I don't know how many hours, and then they're quarantined for 48 to 72 hours before they work again on their first shift again for 24. That's one of their tactics they're using to ramp up production in China, in Shanghai, I should say. Kathy Woods, I told you, already bought in yesterday up to 10 million shares worth of Tesla as the stock crashed 32% in 1 month. So in the past, we've seen Tesla, we've talked about it. It was at 800, then we had it at 750, 700, 650. And now we're down to we're up to 661 today, right now, as I speak. But the next key price point level is 600. Yesterday, Snapchat CEO cut their guidance based off of his comments on what he had to say about Snapchat, which brought the big tech companies and the NASDAQ down also. Snap was at $25 a share, and then CEO came out, made some comments, and it went down to $12.79. So that's a pretty big impact, and that impacted, it's a ripple effect, so it affects other sectors and companies too. So this is not just like a focal one thing or one company affecting this. It's everything affecting everything. Some things are stronger affecting than others. Overall, stock market is still holding its ground from the source that I've been told. There is an FOMC meeting today at 2 p.m. and that can have a huge impact on the market. So right now I'm making this video at 11:56 on the 25th of May. So unless we get any positive news, Tesla may drop. Again, this is a pre-discounted price right now to buy Tesla before there's a shift. That's just, I don't know. I'm not going to get anyone's hopes up, but there'll be a shift. Now, Elon and Twitter, this is another factor that investors are concerned about. And part of this I will have to read, so just, I'm sorry, my eyes won't be at you. But Elon's using his shares as collateral with this Twitter deal. I don't know what else to call it but a deal. The deal was set up when Tesla was $900 to $800. And now, since then, and Elon went out of his way to go to the banks and try to collect this cash that they want too. And so there are many people, many investors, retail and big, I'm going to have to read this part, are worried about if Tesla drops to $500 to $600, will there be some form of revision? If finalized, the Twitter deal, what could happen potentially with Elon's shares? Will he be forced to sell his shares? And then if he does, that could bring the stock down more. But maybe not at this moment in time, but not like, I don't know when, but this is a factor to be considered of. So economic data coming out, initial jobless claims on Thursday, I don't know what time. Key inflation data coming out on Friday, I don't know what time. And now we're going to watch a video from this morning on how this investor, you might know him or know who this is. I don't, but I'm learning. So start it from the beginning.
Outlook for a recession from 30% to 40%. It's not the most likely scenario yet. But I do think that looking into next year, we're still going to make a new high in the S&P 500. But I'm realistic here. The reality is the economic numbers that we've been getting have been weak. The housing numbers were extremely weak yesterday. This morning's durable goods were actually pretty good, but the business surveys for New York and Richmond and Philadelphia are looking very weak for May, which means we're going to probably get a very weak purchasing managers index.
Let me ask you this: why isn't a recession your base case scenario at this point?
Well, I still look at the consumer and I see that the labor markets continue to be very strong. And in addition, consumers have accumulated about $2 trillion in excess savings over the past 2 years. And we are actually now starting to see in April data, M2 come down and demand deposits coming down. So that does suggest that they're dipping into some of this excess liquidity to keep spending. And then I look at the business sector and I'm encouraged by today's non-defense capital goods orders. They were up at a record high. I think companies are going to do what we've discussed before, and that is continue to spend on equipment, particularly on technology, to increase the productivity of their workforce, which is really what is my longer-term underlying optimism is all about. I think some of the really bearish people are looking for this situation to continue well into next year, and I think what they're missing here is that productivity will come in and lower the help to lower inflation.
It's interesting that you mentioned the money supply. It's a conversation that I had as well yesterday with Jeremy Siegel, and I'm not sure if you listened to it or not. But he's growing concerned about the amount of liquidity coming out of the system at the same time that the Fed is doing what it is doing, at the same time that the economy appears to be weakening. I want you to listen to what he said, and I'd love your reaction to it on the other side.
I look at the money supply as a very important indicator. We had, at 1 o'clock announcement today, the second largest monthly decline in the money supply in more than 60 years. I'm beginning to get a bit concerned about overreaction. And maybe some of the weakness we see in the economy is because, the Fed is withdrawing liquidity perhaps a bit too quickly.
I'm curious what you think about that and put the context behind it too. You literally just heard from Professor Jeremy Siegel, one of, if not the loudest person on this network and most consistent for the last many weeks, that the Fed needed to tighten more, that inflation was way out of control, much more than people thought. The Fed needed to be even more aggressive. And now it feels like an about face from Professor Siegel himself, who's seen a million of these cycles before and now worries that the Fed's going to overdo it because he looks at the money supply, the same thing that you just did.
Yeah, I think he makes a very good point. And look, there are a lot of moving parts here, and increasingly they are pointing into a recession. And so that's why I raised my recession odds. But with the rest of the money supply, I would point out that M2 is about $3 trillion above its pre-pandemic trend. So in other words, there still is a tremendous amount of liquidity left over from the past couple of years. And so you have to put that into the context of this April drop in M2. Yeah, it was a big drop, but put that in the context of the huge increase we've had over the past 2 years. I think one of your panels pointed out, it might have been Steve, that we clearly are living in an environment that's unusual in many, many ways and hasn't occurred in a long time, and that's the tightening environment. But that's after an extraordinarily easy environment, and I think there's a tremendous amount of liquidity still in the system. A lot of corporations refinanced their debts at record low interest rates over the past 2 years. If it wasn't for all that, I would be concerned about a more traditional recession. I would make that the most likely scenario. But if you'll allow me, I'm going to watch these numbers as they unfold, and I leave myself open to lowering my numbers or raising my numbers, as I think all of us are.
All right. I mean, that's fair. Willing to give you the benefit of the doubt there. You deserve
Thank
it.
Thank you.
You certainly deserve it. Joe, you have a question for Ed?
I do. Ed, great to see you. So clearly we have inflation. Just today you have natural gas prices above $9. We haven't seen that since before the great financial crisis. You have a deceleration, obviously, in growth. We keep talking about what the economic climate is going to be, recessionary or not. I'm more concerned with the word you used, the environment for investors. Ed, tell me, is this stagflation? Is that exactly right now the environment that we're in? And if in fact it is, what does that mean for investors?
Joe, you're absolutely right. I mean, it's clearly stagflation. Stagflation being high inflation and very little, if any, growth. As a matter of fact, the Atlanta Fed came out today with their latest estimate for the second quarter, and now it's 1.8%, down from 2.4%, and that was because of the housing numbers that were so weak over the past couple of days. They may up that after the durable goods orders number, but it is stagflation. Question is whether it's the 1970s all over again. It certainly feels like that right now, but I think underneath it all, companies are going to respond to labor shortages by continuing to spend on equipment and technology to increase productivity. I know that's too optimistic for most people right now, and kind of focusing on today's numbers. But I think we'll get out of this a lot faster than anything that comparable to what happened in the 1970s. But by the way, productivity collapsed.
Because it just seems almost impossible when in one hand you say, yes, it's stagflation, and on the other hand, oh, but we're going to hit new highs in the S&P next year.
Well, it's a matter of timing. It's a matter of timing, Scott. I mean, clearly right now, it looks like the 1970s. Right now, it looks like increasing odds of a recession. But I do want to maintain an optimistic outlook based on the productivity story, which I think is a solid story.
Okay, fair enough. We will continue to speak with you as well.
All right, guys. If you liked this video and you found it helpful, go ahead and push the like button. It helps out the channel. If you find these videos helpful, go ahead and subscribe to the channel. It really helps out the channel, and I do want to applaud those of you that just recently joined. Welcome. This is an amazing channel, and it's just pure truth and no BS. And that's what I try to stick to. So thank you, viewers, for watching this video, and everyone else who's involved in watching this or seeing this or helping me out. Thank you. Have a great day.